guys, welcome to today's webinar series, which is in partnership with our sponsor broker, Ingot Africa Ltd. Today we are going to be talking more on commodity futures with our guest speaker being Carley, Garner. Welcome.
Thank you for accepting the invite on short notice.
Sure, no problem. Actually, let me get the lighting here. Okay, I'm ready. I'm ready now.
All right, cool. Today it's just going to be more of an open-ended conversation. We'll go through your most recent trades. It's not so much scripted as the ones we've had before, so we'll just stroll with how you've been trading recently. Yeah.
Okay.
Yeah, and with me is Faith. Faith, you can introduce yourself.
Hi.
Hi. Nice to meet you.
Yeah, so I think we can just get started because we will finish at exactly in 40 minutes.
Okay.
It's truly an honor to have you back on the lounge, Carley.
Thank you for having me.
Yeah, maybe as we start off, I was doing my research. You can tell us the difference between the like 4 exchanges, commodity exchanges in the US. So there's like the CME, the Chicago Mercantile Exchange. Then there's the Chicago Board of Trade, CBOT. Then there's the New York Mercantile Exchange. And there's the Commodity Exchange, COMEX. So like, what role does each of those play when it comes to commodity futures?
Right. So I'll start by saying the thing about commodity futures is they're exchange traded. As you mentioned, there's 4 exchanges in the US, which means they're centralized. So anybody that's transacting, like buying or selling crude oil or grains or whatever it is they're buying or selling, it's all going to a centralized marketplace. This is different than products that you see overseas like CFDs or spot Forex, where the broker itself is creating like a mini market for its particular clients. These are really big centralized markets that everywhere in the world routes are ordered to. So if you're in Dubai or China or wherever you are in the world, and you send an order to buy crude oil on the CME group NYMEX exchange, it all goes to the same place. And so what that does is it creates a lot of liquidity, a lot more liquidity than you would see in the smaller markets, like I mentioned, like CFDs and things like that. So with that said, the 4 exchanges that you named, they used to operate completely independently. They had their own opening and closing times, and actually they still kind of do for the most part. They had their own rules on stop loss orders and things like that, their own basically separate mechanisms of operating. And over the years, the CME group has acquired all of them. So they are all owned by the CME group now, whereas that wasn't the case let's say 15 years ago, I think is when they started acquiring these exchanges. So they still sit as divisions of the CME group, but they handle different contracts. And what I mean by that is, for example, the Chicago Board of Trade, the CBOT, handles the grain contracts, corn, soybeans, wheat, those types of things. The NYMEX exchange handles energies, so natural gas, crude oil. The COMEX exchange handles metals, silver, gold, copper, those types of things. And then we have finally the CME group that is they're the financials. So they handle like short-term interest rates, treasury. Well, actually I take it back. They don't handle treasuries, stock indices, currencies. So basically each exchange offers a different product, but they're all owned by the same conglomerate. The tricky thing is each exchange has different opening and closing times, different rules. Well, the rules have kind of been standardized across those 4 exchanges for most things, but they started as separate entities, and so they still operate a little differently from each other.
All right, understood. And then, so can clients trade from each exchange separately, or do they have to just focus on the CME, which is now like the one that manages everything?
So to be honest, I would say most clients have zero awareness of what exchange they're trading on. All they know is they open up their trading platform and they enter in the symbol they want to trade and they hit the button. I don't think they're aware of, they probably are aware that it's the CME group as the conglomerate exchange, but I don't think they're aware of the division that it's going to. And I'm not sure it really matters too much as long as you know the specifics of the contract you're trading, the contract size, the open close time, the margin, those sorts of things. I mean, it's good information to know, but I don't think people are really that aware of it, to be honest. The nice thing is brokers, futures brokers or commodity brokers like us, we offer a platform and traders can execute their trades on any exchange in the US and even abroad. So like if they want to trade the DAX or Brent crude oil, they can do it on our trading platforms. And even though the order is not routed to Chicago, it's routed elsewhere in the world, it still actually is executed in about the same amount of time, at least precisely. I mean, maybe not to the 10th of a second, but it's pretty quick. So traders have kind of gotten spoiled during, with the world of technology. When I first started in the business, it was a whole different world. We would have to actually make phone calls overseas or wherever it was that we were trying to execute trades. We even made phone calls to each of the exchanges of the US. If somebody wanted to buy or sell a product, we didn't enter it in the computer. We actually picked up the phone and called somebody that was standing in the pit in New York or Chicago. So things have changed for the better over the years.
All right, we can take us through an example of how someone or an individual can actually trade a futures commodity contract. Maybe we can specialize on agricultural commodities, corn or wheat, and then we can do like metal and an energy, crude oil,
Okay.
in terms of execution.
Sure. So, okay, that's a good question. So the thing that most people kind of fail to realize is because we're trading centralized exchanges, we're also trading products and venues that are regulated by the US government, which requires a good amount of paperwork. So before you start trading, it is necessary to complete a trading application. The application will ask questions such as your trading experience, your financial situation, have you committed any crimes? Do you have any felonies? Those sorts of things. So there's some basic hurdles to jump over, but the vast majority of traders or applications are accepted. So it's not something that's a deal breaker for most people, but it is something that takes 20-30 minutes to complete. And then once the processing of the application is complete, then clients are free to fund their account. When you're trading futures, the rules are a lot stricter than other markets. Again, CFDs, things like that. You must fund the account with actual cash. So you can send a bank wire. Some brokerages allow you to send ACH money transfers, but you cannot use credit cards or things like that to finance futures trades due to regulations. And it's, in my opinion, good regulations. I'm not against that at all. Once the account's open, funded, ready to go, it's super, super simple. Most brokerages have various platforms to choose from. Like us, we have access to over 30 platforms. Most of our clients use one or two. So most clients pick the cheap platform or the free platform, and it has all the functionality. Buying and selling a commodity is really as easy as long as you know the symbol, or at least know the name, such as crude oil, corn, soybeans. You can literally just pull it up on your quote board or type it in and hit a button, click buy or sell. So it's really, really easy. They've simplified the process a lot over the years. Probably not unlike what you would see in a Forex or CFD platform. It's very easy. It's just point and click, buy or sell. The tricky part is knowing the difference between stop orders, limit orders, stop limit orders. And I really highly encourage people to make sure they have that knowledge, not only known to them, but very well known, so that in the heat of the moment, when things are moving quickly and there's a lot of pressure, you don't accidentally place the wrong order type, because that can be an expensive mistake. But buying and selling is really easy, and most of the brokerages now have mobile apps, so they can just do it on their phone. Real couple clicks, you're in and out. Futures can be bought or sold in any order. So if you think crude oil is going down, you could sell it now and then buy it back later, hopefully at a lower price, or vice versa. So that's one thing that people also sometimes don't realize. If you're buying corn, soybeans, wheat, it's the same process. But one thing to keep in mind in the agricultural markets is their trading hours are limited relative to some of the other stuff. So crude oil trades 23 hours a day. Corn, soybeans, they trade, haven't counted the hours a day, but they trade an overnight session and then they pause. and then they trade a day session and then they pause for several hours. So they're not necessarily open around the clock like some of the other markets are. So you want to be really, really aware of what the market times is or are for the markets you're trading.
Right.
Okay, so can you briefly explain the role of margin and leverage when it comes to futures trading?
Right. Each market has its own. It's not like some of the other products that people might be trading that have a ratio of leverage. In futures, each market has its own margin requirement, and it's a dollar amount. It's not a percentage of the underlying asset. It's a set dollar amount. That dollar amount can adjust a couple of times a year, and it does with volatility. But it's usually quite a bit less than what the futures contract represents. So I'll go back to crude oil just because the math's a little easier. With crude oil trading, I'm just going to round it to $80 a barrel. That futures contract is worth $80,000 worth of oil, and the margin on it fluctuates. It can be anywhere from 3,000 to 9 or 10,000. I think I've seen it a little above that, but we'll just say it's 8,000. So for $8,000, you're making or losing money based on $80,000 worth of crude oil. So you can see how someone could get into trouble. If crude oil goes up a dollar, you make 1,000 or lose 1,000. If it goes up or down $8, you make or lose 8,000. And if you're trading on maximum leverage, that would wipe out the whole account. So what I mean by that is, if you have an $8,000 US dollar account and you buy crude oil and crude oil drops $8, you just wiped out the whole account. What I generally tell people is always give yourself room for error. So if you have an $8,000 account, don't buy a full-size crude oil. You can buy a micro crude oil. The micro crude oil futures is 1/10 the size. So the margin is 800. And if crude oil dropped $8, you would lose $800, not $8,000. So it's a lot more manageable. And the other thing I'm going to point out about that is if you're trading a very small position relative to your margin available, you're essentially removing the leverage or at least reducing it. So if we go back to the full size oil contract example, if you had $80,000 in your account and you bought one crude oil future, you eliminated all the leverage built into the system. So in order for you to blow out your account, crude oil would have to go to zero, which we have seen. So it's not impossible, but it's not likely. So and if crude oil goes up, you're going to make $1,000 per dollar, which isn't as exciting on an $80,000 account as it is an $8,000 account because of the percentage difference. But the reality is the less leverage, the more room for error you have, and probably the more likely you are to hopefully succeed at this game.
All right, understood, Carley. Maybe now you can share your screen and then you can take us through like a live chart example of your most recent trades on metals, energy, and maybe corn or wheat. Okay,
I've got a couple I can show you. I'm gonna have to move over to my desk here.
All right.
Okay. Okay, so you should now see my screen. Is that correct?
Yeah.
Okay. All right. So I'm actually going to go to a couple of newsletters here. I have a couple trades that we have. Sorry, just give me 2 seconds here. Okay, so there's a couple of trades that we're going to go over today, just real simply. These are trades we recommended to our brokerage clients. Some of them worked out very well, some of them did not. And so we'll just give you a couple of samples here. A couple, let's say, I think it was early October. It was about early October. We had recognized that the treasury market, the 30-year treasury market, was in capitulation. And when we pulled up a daily chart, oh, I take it back. I'm sorry. We're going to look at gold first. I apologize. This is the gold market, which gold was also in capitulation during this time. Gold and treasuries at the time were trading very highly correlated. So basically the narrative was, as treasuries were collapsing, meaning interest rates were going higher, gold was becoming less and less attractive because gold does not pay interest. And so the gold market was suffering pretty substantially. When we pulled up a chart, we could see that there's a trend line here that gold was testing. Now, trend lines hold more often than they don't. So there's a pretty good indicator, but it's not a guarantee, obviously. And so what we suggested to our clients, instead of buying a futures contract here and run the risk of the market falling out to the next support level, which was 1750, that'd be like a $10,000 loss on one futures contract, just to give you an idea of what we're talking about. Or if you were trading a micro, it would have been a $1,000 loss. Micros are 1/10 the size of the full size futures. So, traders could have bought a futures and placed a stop to limit the risk. And that's one way to do it. But the reality is stops are very prone to getting hit at the worst times. Sometimes a lot of people get stopped out really near the low of the trade or the low of the day, and the market goes their way. So we like to do it with options. It gives us a little more lasting power. We can have more room for error and let the trade play out. So the idea was we wanted to buy a call spread. We bought the 1900, or we recommended to buy the 1900 call and sold the 1975 call. This is in February gold. And then we sold the 1750 put to pay for it. And so here's what it would look like on a trade ticket on our platform. Some other platforms might look different, obviously. But we are getting executed a very small credit, $10, $20 basically is what that amounts to. Basically, it's a free trade. So the put that we were selling, the 1750 put, was paying for us to purchase the 1900 and 1975 call spread. So what this means is if gold goes up, we make money from 1900 to 1975. Above 1975, we're capped out. We don't make anything beyond that. But the risk is, because we sold this 1750 put to pay for this call spread, we have unlimited risk below 1750. And that requires margin. And that also requires just simply, obviously, accepting the risk of unlimited losses below 1750. When you say it like that, it sounds really scary. But the reality is, if you're buying a futures contract, you have theoretically unlimited losses. So it's basically the same risk as being long a futures contract from 1750. So that's another way to look at it. It sounds scary because people tell you don't sell options. And I get that, because things can get hairy, that's for sure. But it's something you should at least be aware of and consider. To give you an idea on how the math works, that call spread, if we bought the 1900 and sold the 1975 without selling the put, the trade would cost us about 1,500. That would be our max risk. Because we sold this put to pay for it, we brought in $1,500 in cash to sell that put. It becomes a free trade. This is what the stats look like for the trade. The margin was about 5,300. So you could do this in a relatively small account. I would not recommend doing this in a $5,000 or $6,000 account. You'd want to have a lot more room for error than that. In a perfect world, maybe $20,000 to $25,000 or more to allocate towards this trade. But at least, I'd say at least 10,000. The most you could make on a trade like this is about 7,500. That's if you hold the expiration and gold's above 1975. As we know now, gold is above 1975. So this trade actually did very well. Unfortunately, we did recommend most of our clients offset it early. So we got out. Gold's trading up in this area right now. And we recommended taking profits for most people. Some people listened, some didn't. Hopefully some of them didn't listen. But the reality is, with this kind of stuff, you're usually better off taking profits early as opposed to waiting to squeeze out the best case scenario, simply because a lot can happen in a short amount of time, and you don't want to turn a winner into a loser. The first step on a trade like this, all of our risk is in the 1750 put. So the first thing we'd want to do if the market went our way, as it did this time, is to buy that 1750 put back. and take the risk off the table and hold the call spread and hope it keeps running. I'm going to see if I can pull up a gold chart real quick here so you can see where we're at with this. All right, you can kind of ignore the text on here, but this trade was put on with gold down here. Well, yeah, I actually ended up redrawing this line. And that's the thing about technical analysis. You can change as it goes. The markets change, so we should change. Our analysis can change. It's just how it is. It's messy. It's an art, not a science. But you can see gold was down in this area, and now we're trading all the way up here. So somebody that did hold that trade indefinitely did very, very well. Off the top of my head, I don't remember what most of our clients were making on this, but probably somewhere around half of the max profit, which, to be honest, is still really good in a very short amount of time, because gold, we were lucky enough that gold went our way after this position pretty quickly.
All right. So when you're trading gold, I'm assuming you're trading the gold E-mini futures as you have shown us on the chart.
It's a gold futures contract that's traded on the COMEX exchange. So it is a futures contract. It's not an E-mini, but it is a futures contract. Gold has multiple contract sizes. There's the full size contract's 100 ounces of gold. Then there's a mini contract that is 50 ounces, and then there's a micro contract that's 10 ounces. So it gets a little bit confusing. I generally advise people to kind of skip the mini and either use the full size or the micro. If you're trading a relatively small retail account, micros are really great because you can scale in. So even if your goal is to have 50 ounces of gold and you want to do it with futures, not options, obviously the trade we just showed was an option trade. You could buy one micro future today, and then if the market goes against you a little bit but you're still bullish, you could buy another one at a better price, and you can scale in and scale out a lot easier. The advantage of scaling in and scaling out is just like the theory of dollar cost averaging. We don't know exactly where the lows or highs are going to be, but if we can get in the general ballpark and we've accumulated a handful of buys, usually your average buy price is going to be better than if you just went all in all at once. And so that's the idea of that. And with the micros, you can do that a lot easier than the full size contract.
All right.
I'm sorry, go ahead. Do you have another question?
Yeah. What's your approach to managing multiple positions in different futures contracts simultaneously?
So multiple positions gets really hairy, especially in small accounts. So if somebody's trading, let's say, an account under 20,000, I would suggest just having one position, keeping it really simple. And I'm going based on some of these option trades that we've talked about today, and maybe that we might get to next. If you're trading a larger account, then multiple positions make sense. I mean, 50 to 100,000, you can probably put 2 or 3 of something like this in, maybe 4 or 5, depending on what you're doing. Some margin, just to give you an idea, like gold has a relatively high margin because it's a higher risk market relative to corn or sugar or some of the other stuff that we trade. So one position in gold is actually a relatively big position, whereas one position in corn is pretty small. So it's not a black and white equation. In a perfect world, if somebody had enough money to allocate towards something like this, to handle multiple positions, it's a really big benefit because most markets are uncorrelated. So for example, if you had a gold trade, treasury trade, well, treasuries and gold are actually correlated, so I'm going to take that back. If you had gold, corn, soybeans, crude oil, something like that, different trades going in those handful of markets, you're really not going to see a high level of correlation between the trades. So you can actively just kind of set it and forget it. The trading strategies that we recommend are they're not intended to be traded in a high frequency. We're not day trading. We're not even swing trading. These are intended to be held for weeks or months. Unless we get really lucky and the market immediately goes our way, then we would suggest getting out in a couple of days, but that's an exception, not a rule. So I'm really big on pushing people to have the mindset of you can't lose money from the sidelines. So anytime you have open positions just lingering, you're increasing your odds of being in the wrong place at the wrong time. So it's a really good idea to pull risk off the table where you can, as opposed to just being complacently holding on to a portfolio and just letting it ride. If there's an opportunity to take short puts or short calls, like naked risk exposure off the table and take a profit on that leg, while you can let the limited risk portion of the trade run, go for it. It's always a good idea to do that. But to answer your question, it's managing multiple trades at one time can get very overwhelming. So it's a good idea to less is better, less is more.
All right. And maybe now, before we take the questions, in the last 10 or 12 minutes from the participants, you can maybe show us a chart example for an energy or oil, crude oil, that is.
Okay. Yeah, let's take a look at, I'm going to pull up some crude oil charts here.
All right.
And then I'll show you a trade that, kind of go through a real quick trade that we had recommended. So this is our monthlies. I apologize. This is a monthly chart of crude oil. This is what we basically, before we even look at a daily chart or a weekly chart or try to form an opinion, we look at this chart first to see what's going on. And then we take that and apply it to the other time frames and make sure everything lines up. So here's what we see. This is a trend line that dates back to 2016 in crude oil. And we can see it fell through during COVID, but to be honest, COVID's basically a black swan. Can those things happen again? Sure, they might, but the odds of something like that happening is off the charts rare. So we've just decided to draw this trend line right through where probably oil would have bottomed had we not had COVID. Continue from there. So that trend line comes in right around 68, 67. Crude oil has a tendency to trade lower during the month of December, and it generally bottoms out mid to late December. So seasonals are bearish. The trend is bearish. If you look at a daily chart, we're in a downtrend. Also, speculators are still net long even after the sell-off. So everything I look at tells me, even though we're getting some intraday rallies and things like that, and the OPEC meeting is a wild card, the odds are we should see 68 before we see another rally. And that rally could get up into the 9,900 areas. But before that happens, I think we see the high 60s. So with that in mind, knowing that there's some downside risk, but we also think eventually the market pulls away to the upside, we did suggest a trade like this to our clients just to get a foot in the door, because everybody was contacting us saying they wanted to be long crude oil because they believe that tension in the Middle East and everything else will push prices higher. And I can understand why they would think that or feel that, and that's definitely a possibility. But as I just showed you in the last chart, there's a real chance of much lower prices, let's say $8 to $10 lower in oil before we get any kind of rally. So what we suggested was a call butterfly. It's a little bit complicated, so I'm going to make it as simple as I can. A call butterfly has limited risk. The most you can lose, no matter what, is what you pay for the strategy itself or the option spread itself. We're getting in for about 80 cents, which is $800. So if oil goes to zero, the most these people that participated would lose is $800. Has about 2 months to expiration, slightly less than 2 months to expiration. It expires on January 17th. The margin is zero because the risk is limited. And if everything goes perfect, and the odds of it going perfect are not great, but if it did, here's how that would work. A butterfly is basically buying one call option close to the money, selling 2 call options out of the money to pay for that call that you just bought, and then buying another call up above to limit your risk. So the way it works is you start making money at $80 as the market goes up. You max out at $85, and that max out is 4,200. So if oil's exactly at 4,200, if oil's exactly at $85, 2 months from now at expiration, you would make 4,200, assuming you held on the entire ride. If oil continues above 85, you start giving your profits back and you run out of money at 90. So above $90, you don't make anything. The spread just expires worthless. Below $80, the spread expires worthless. But between 80 and 90, you get something. And the best case scenario is 85, you get 4,200. So you can see how this is just a low risk, very slow way to play it. It takes some luck, and these types of trades don't, you don't see the profit materialize until right before expiration. So you're kind of trapped in. But the alternative is if you buy a full-size futures contract and we drop $10, you're out 10 grand. This way, you're only out 800 worst case scenario. And even if the market does drop $10, you're still in the trade. As long as there's timed expiration, the market can rebound and you can be right there for it. We've seen oil do some really wild things. So this is a daily chart, by the way. Hopefully you can see that. So this was the idea of the trade. We think it could be around here at expiration, which is why we suggested that trade. But we also think the bottom could fall out. So this would be, even if we go to 66 and rebound, we would have plenty of time to get back into the 80s, and that's what we think maybe might happen. And if it doesn't, the trade loses 800. It's not the end of the world. We can get more aggressive with it. If we get down to 66, we'd probably do something a lot more aggressive on the upside.
All right. At this point, I think I'll take questions from the participants. We have like 4 ladies in the room, and we have also on the chat, I can see this minor. If you have a question for Carley, kindly ask.
Okay.
And then as maybe we wait for the final for questions, maybe we can also go through a corn chart just to cover an agricultural commodity, and then we call it a wrap.
Okay, sure. You want to talk about corn?
Yes.
Okay. So corn is the most liquid agricultural contract traded on the exchange. So it's a good one, especially for those that are just getting into commodities. There's also a I take it back. There's a mini version available. So the standard contract is 5,000 bushels, meaning for every penny corn goes up or down, the trader makes or loses $50. The micro contract is 1/10 the size. So nope, I apologize. It's 1/5 the size. The mini is 1/5 the size. So if corn goes up or down a penny, you make or lose $10 instead of $50. So for beginners, it's a really, really great way to get a foot in the door without a lot of risk and without a lot of margin. The margin's under $500 for the mini. The margin is a couple thousand for the full size, just to give you an idea. So it's also a lower margin contract than gold or crude oil or some of the other stuff we've talked about. And it trades in a day session. It pauses for several hours and then trades in a night session. So there's a little bit of a learning curve there, but it's right. I don't know if you're following the price of corn. Corn has had a wild couple of years, weather concerns and all kinds of weather patterns that have been abnormal, forced corn prices to $7, $8, which was a historically high price. We're all the way back down in the mid 4s. So we've cut the price in corn almost in half, but that's to be expected. Commodities go down more than they go up. And the reason is when prices get really high, producers produce more and it floods the market and prices come back down. Also, consumers don't buy as much as when prices are high. They start looking for substitutes or doing other things. So commodities are self-correcting when it comes to price, which is why you rarely see a commodity hold a rally. Usually it's a very sharp rally and then maybe even an even sharper decline on the way down. And that's exactly what we've seen in some of the agriculturals. Corn and wheat. Wheat was a big one. It benefited from the war in Ukraine for a handful of months. And then when we realized that we actually are getting more wheat on the market than we thought we were going to get, or maybe even before the war, because Russia's using wheat sales to finance its operations. the wheat market went from $13 to $5. So you can see some really dramatic sell-offs. The good news is we're starting to, well, not the good news, but the positive news for corn is we're starting to get below cost of production levels. We've already seen the harvest in the US. Corn is harvested in October, November. So the harvest has run its course. Most farmers are in the process of selling their inventory right now, which is putting pressure on price. So seasonally, you tend to see a bottom in December, and I think that that's probably something that we might see here in the next couple of weeks. So we're starting to turn bullish in corn, but very cautiously so far.
All right. With that, I think we've come to the end of our session. Thank you so much, Carley, for your time. And guys,
Thank
if
you.
trade commodity futures, you can do so on Carley Trading. They also have a trading app. You can also do so using our sponsor broker. They have a US office for onboarding US clients as well. And we'd love to host you again next year, Carley. We wish you a happy festive season with your family and your friends. And until we speak again, good times.
Thank you. Thanks for having me.
All right. Bye.
Bye.
All right, thank you guys for tuning in to today's webinar session. We've had an in-depth conversation about how to trade commodity futures, and Carley has taken us through technical charts. We've analyzed gold, we've also analyzed crude oil, and we've also touched on corn. If you wish to trade commodity futures, you can do so using Ingot Africa Ltd. You can do so via the link. And also reach out to us if you want to learn how to trade via our website, www.forexstl.com.